Volatility in finance measures the degree of variation in a trading price series over time. It quantifies how much an asset's price fluctuates, indicating its instability. High volatility suggests significant price swings, implying higher risk. Conversely, low volatility indicates more stable prices and lower perceived risk. Asset price volatility refers to the rate at which an asset's price increases or decreases. High volatility indicates significant and rapid price movements within a short time frame. This can result in substantial upward and downward swings in the asset's market value. Conversely, low volatility signifies that an asset's price remains relatively stable. Such assets experience minimal fluctuations, maintaining a consistent market value. Volatility is a key metric for assessing investment risk and potential returns. The relationship between risk and reward is a fundamental concept in finance and investment. High volatility in asset prices is often linked to the potential for higher returns. Significant price movements create opportunities for substantial gains for investors. However, this increased volatility also introduces a greater risk of significant financial losses. Investors must carefully weigh the potential for profit against the possibility of loss. Understanding this balance is crucial for making informed investment decisions and managing portfolios effectively. Market volatility refers to rapid and unpredictable price changes within financial markets. It is influenced by various factors, including imbalances in supply and demand. Key drivers also include economic news, geopolitical events, and shifts in investor sentiment. These combined elements can trigger significant and swift price movements across assets. Volatility in financial markets refers to the degree of variation of a trading price series over time. There are two primary types of volatility used in financial analysis: historical and implied. Historical volatility is calculated using past price data of an asset. It quantifies the actual price movements that have occurred over a specific period. Implied volatility, conversely, is derived from the current prices of options contracts. It represents market participants' expectations of future price fluctuations for the underlying asset. Volatility in financial markets quantifies the degree of variation of a trading price series over time. Mathematically, volatility is frequently measured using the standard deviation of an asset's returns. Standard deviation assesses how much individual data points deviate from the average value. A higher standard deviation indicates greater price dispersion around the average, signifying higher volatility. Different asset classes exhibit varying degrees of volatility in financial markets. Volatility measures the rate and magnitude of price fluctuations for an asset. Cryptocurrencies and speculative stocks typically show higher volatility. Conversely, bonds and established blue-chip stocks generally demonstrate lower volatility. Traders continuously monitor market conditions to inform their strategic decisions. Market volatility, characterized by rapid price fluctuations, significantly influences trading approaches. In highly volatile markets, some traders adopt short-term strategies. These strategies aim to capitalize on swift price movements and frequent trading opportunities. Conversely, other traders may choose to avoid highly volatile conditions. This adaptation reflects a risk-averse approach, prioritizing stability over potential rapid gains. Volatility is a critical factor in financial option pricing models. Models like Black-Scholes rely on volatility as a key input for calculation. Higher expected volatility directly correlates with increased option premiums. This is because greater volatility implies a higher probability of the option expiring in the money. Thus, volatility reflects the potential for significant price movements in the underlying asset. Diversification in portfolio management aims to reduce overall volatility. This is achieved by combining assets with varying risk-return profiles. Assets selected for diversification typically exhibit low correlations with each other. This strategic approach helps to smooth out portfolio returns over time. High volatility systems, like the Gates of Olympus game, exhibit significant fluctuations in outcomes. These systems are characterized by the potential for very large payouts or rewards. However, these substantial rewards occur less frequently compared to low volatility systems. Engaging with such systems requires a high degree of patience from participants. A higher tolerance for risk is also necessary due to the infrequent nature of large gains. Highly volatile systems are characterized by unpredictable outcomes and significant fluctuations. In these systems, the probability of achieving a substantial win or positive outcome is inherently low. However, when such an event does occur, the magnitude of the payout or reward is exceptionally high. This combination of low probability and high reward creates a strong allure for participants. The potential for a large, infrequent payout drives engagement despite the higher risk of loss. Highly volatile systems are characterized by frequent, small losses or periods of no returns. These systems can significantly challenge a participant's resolve and emotional resilience. The continuous occurrence of minor setbacks can erode confidence over time. Such systems also pose a risk to sustained capital as small losses accumulate. Managing these frequent drawdowns is crucial for long-term participation and success. High volatility in financial markets or other domains can create a psychological trap for individuals. This trap is characterized by the intermittent reinforcement of significant gains or large wins. These infrequent but substantial successes can lead to an overestimation of future positive outcomes. Individuals may develop an inflated sense of their ability to achieve future success. Simultaneously, this overconfidence causes them to overlook the cumulative impact of small, frequent losses. The psychological trap thus distorts risk perception, leading to potentially detrimental decision-making. In systems characterized by high volatility, outcomes are unpredictable and often extreme. When a significant positive outcome or large win occurs in such a system, it triggers a specific brain response. This event initiates a powerful release of dopamine, a neurotransmitter associated with pleasure and reward. The strong dopamine surge reinforces the behavior that led to the large win. This reinforcement creates a compelling desire to repeat the action, seeking a similar rewarding experience. This desire persists even when the statistical odds of another large win are unfavorable or against the individual. The illusion of control describes a cognitive bias where individuals overestimate their influence over external events. This phenomenon is often observed in highly volatile or uncertain systems, such as financial markets. Participants may believe their strategies can predict or influence unpredictable outcomes. This belief persists even when faced with objective evidence of randomness or negative results. The illusion can lead to continued engagement in risky behaviors despite consistent losses or lack of actual control. The gambler's fallacy is a cognitive bias affecting decision-making. It leads individuals to believe past outcomes influence future independent events. This bias incorrectly assumes a streak of one outcome makes the opposite outcome do. For example, after a series of losses, one might feel a win is imminent. This belief encourages further risk-taking, despite the odds remaining unchanged. Understanding this fallacy is crucial for rational decision-making in probabilistic scenarios. The near-miss effect describes an outcome that is very close to a win but ultimately results in a loss. This psychological phenomenon is particularly powerful in volatile or unpredictable systems. Near misses can activate reward pathways in the brain, similar to actual successful outcomes. This activation helps maintain engagement and motivation despite the ultimate failure. The sunk cost fallacy describes a cognitive bias influencing decision-making. Individuals continue investing resources into a failing endeavor due to prior investments. This behavior is driven by the hope of recouping past losses, rather than cutting them. It often leads to irrational choices, escalating commitment to a volatile system. High volatility in markets or situations can trigger intense emotional responses in individuals. These responses manifest as emotional highs, such as euphoria, or lows, like fear and panic. Such emotional fluctuations significantly impair an individual's capacity for rational decision-making. The influence of strong emotions often leads to impulsive actions rather than considered choices. This impulsivity can cause deviations from pre-established, well-thought-out plans or strategies. Maintaining emotional discipline is crucial to adhere to rational plans amidst volatile conditions. Effective risk management is crucial for individuals and organizations. A key component of this is understanding volatility in various contexts. Volatility refers to the degree of variation of a trading price series over time. Understanding it enables setting appropriate stop-loss limits. It also helps in determining optimal position sizes for investments. These measures are vital for mitigating potential downside risks. Effective expectation management is crucial when engaging with volatile assets. Volatile assets are characterized by significant and unpredictable price fluctuations. It is important to recognize that substantial gains are typically infrequent occurrences. Conversely, Experiencing losses is an inherent and unavoidable aspect of investing in such assets. Acknowledging these realities helps investors maintain a rational and balanced perspective. This approach mitigates emotional responses to market movements, fostering more stable decision-making. Long-term investors prioritize sustained growth over immediate market fluctuations. Short-term volatility is often less concerning when asset fundamentals are robust. Strong underlying asset fundamentals indicate a company's financial health and potential. These fundamentals include stable earnings, competitive advantages, and sound management. Adopting a long-term perspective helps investors navigate and endure market downturns. This strategy allows assets time to recover and grow, aligning with long-term financial goals. Behavioral finance explores the psychological factors influencing financial decisions. It reveals how cognitive biases can lead to irrational choices in financial markets. These biases are particularly evident in volatile economic environments. Understanding these psychological effects is crucial for effective financial management. Self-awareness of one's own biases is key to mitigating their impact on investment outcomes. High volatility in financial markets presents a dual nature for investors. It offers the potential for significant financial gains within short periods. However, it simultaneously introduces substantial risks of considerable losses. Navigating volatile conditions demands careful consideration and a disciplined investment approach. Investors must manage both the financial and psychological challenges inherent in high volatility.